and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today is Craig Jeffery, Managing Partner at Strategic Treasurer. Craig, I'm delighted to have the opportunity to converse with you again. So a big thank you to you for taking the time to share your perspectives with us on topics that impact the world of cash and treasury management.
I'm always happy to be on Open Treasury. It's good.
Thank you. In today's edition, we'll discuss 4 topics, namely FBAR filing and key considerations for U.S. corporate treasuries before the April 15th deadline, crucial priorities for navigating currency management in 2024, JP Morgan chases AI-driven Cashflow tool that has helped some of its corporate clients cut manual work by 90%, and finally, corporations are grappling with counterparty concentration risk. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com, either by visiting the website or by following the links provided in our show notes. Let's start today's discussion with our first story, which is about FBAR filing and key questions or considerations for U.S. corporate treasuries before the April 15th deadline. In recent years, the U.S. government has markedly stepped up its enforcement efforts concerning the reporting of foreign bank and financial accounts, commonly known as FBAR. So for U.S. companies filing FBAR with FinCEN, the U.S. Treasury Department's Financial Crimes and Enforcement Network is vital. With the deadline to file FBAR coming up on April 15th, it would help U.S. corporate treasury consider the 15 important questions that I have written about in an article published in ctmfile.com. Addressing these questions will assist corporate treasurers and their teams in gaining a comprehensive understanding of their FBAR obligations and enhancing their overall preparedness for such filings. Craig, I won't delve into the 15 questions published in the FBAR article, but what I will ask of you to highlight is a few key questions or considerations that corporate treasury should examine carefully when it comes to FBAR filing. Also, why should corporate treasury spearhead the FBAR filing effort?
So compliance is one of those essential things you have to do, whether you think they're valuable or not valuable, and foreign bank account reporting is certainly one of those things. So I think some of the preliminary questions are any of the entities in our organization subject to foreign bank account reporting? That's the first question. Once you answer that, you can then answer who is responsible for filing. There's individual filers. And those questions are easy to ask, a little bit harder to dig into. And so, what are the types of entities that are required to file? Which ones are excluded from filing? There's a range of decisions for that, but that's an early question. Then if you determine that you are required to file, who are the individual filers that need to be identified? And that's another area. We can all think of who is a signer on a bank account. That's pretty easy to identify. You send the information in, you send the wet signatures or the scanned signatures into your bank through the portal or through direct method. Those are all signers in terms of how Treasury would think of those. But there's also portal signers, what we call portal signers. These are those people who by themselves or working in conjunction with another person have the ability to, enter, approve or release, essentially enact a transfer of funds. And not all of those are signers from a bank perspective, but they're signers from a FinCEN perspective. So FinCEN is part of the word financial crimes enforcement network, fin from financial and crimes enforcement network, making FinCEN. So you're defined as a signer if you are a portal user who can enact these transfers in conjunction with someone else. So a digital way of doing that, which is certainly falls under the category. That's the first set of questions, like, do any of our entities have responsibility and who are the signers? Then the next set of questions is, how big is our scope for doing this? Is this something we want to do on our own? Do we have much of this information captured with our accounting system, with our if we're using TIS with TIS, or if we're using a treasury management system, Does it have most of the information in there? Does it have daily balances, the high balance for the part of the year that's relevant? Does it have all the signers loaded into it? So that's another set of questions. Where do we have that information? Is it in a system? Is it in multiple systems? Is it in multiple people's heads that we have to gather? Those are some of the ways of how do we administer that. You asked if corporate treasury should take the lead in FBAR filings. Corporate treasury has to be part of FBAR filings because at least at a minimum, they're providing high balances. If someone else, let's say someone in tax, is providing the filings or someone in legal is doing that, because sometimes legal or tax will take the initiative to do that. Now, Treasury is going to be involved no matter what, but we're finding more often than not, in other words, more than half the time, Treasury is responsible for handling these types of filings. They're involved in 100% of them, but they're taking the lead in the majority of the cases. But to your point, should you do it on your own or should you use a third party? I'll disclose, we do FBAR filings for a number of companies. We saw it as important. And the reason we got into doing that, this is not really a pitch, this is just an explanation, is compliance is required. So it's an essential activity. Just because a treasury group or a tax group can do a function does not mean that they should do it. If it's something that's repeated regularly, that occurs, let's say monthly, sales tax filings, other items that require a significant amount of time, usually you're going to have that in-house expertise. Something that comes up once a year is very specialized. There's changes. Oftentimes, it was our view that companies would benefit from someone who focuses on that. So that's why we moved into a business of doing that. So that question of can we do it and should we do it? If you have a system that helps you gather the information more effectively, that makes the process much easier, whether you do it on your own or whether you use a third party. The other questions are, are you going to do the filings for the individual signers? You have to do the corporate filings as a company. You can force or make your own signers, file the proper FinCEN forms, make their notations on their regular tax filing, which countries they have, authorization to move funds, or you can file on their behalf. We think it makes more sense for the corporation to file on behalf of the individual FinCEN signers, so you don't have to share all the account information out, and so that you can, because they're signing and moving funds for the organization. So why should they have an extra personal burden when they do that? Those are the things that make sense to me on that.
Thank you for highlighting the key considerations to help timely, efficient, and accurate FBAR filing, including the benefits of seeking external expertise or outsourcing the reporting of foreign financial accounts. In addition to reviewing content published about FBAR filing on CTM File, our audience can derive value from attending Strategic Treasurer's upcoming webinar on FBAR titled How to Never Worry About FBAR Again. This webinar is scheduled for April 4th at 2 p.m. Eastern Time, so I would urge you to sign up for it on Strategic Treasurer's website.
I think marketing came up with a term, how to never worry about something. I don't think I know I didn't come up with that title.
Well, it's a catchy title. Let's now shift our discussion to the second topic, which is about the key priorities for navigating currency management in 2024. This year, central banks around the world are likely to cut interest rates. The US-China trade relationship is expected to remain fractious, and geopolitical risks are anticipated to maintain their hold on the headlines. Additionally, the world is heading to the ballot box in what is considered the biggest global election year in history. These factors point to a potential volatile currency market in 2024. In its recent report, Currency Management Priorities for 2024, Cantox provides corporate treasurers and CFOs with actionable measures to address upcoming challenges and opportunities in currency management. This includes leveraging currencies for growth, moving away from selective hedging to systematic hedging, optimizing forward points, enhancing exposure netting, centralizing forex management, and integrating forex into liquidity management. Craig, from a corporate treasury perspective, what would be your top 2 or 3 priorities for navigating currency management in 2024?
Yeah, there's quite a bit in that report, and some of it's hard to unpack in a podcast. One thing I liked and had a problem with in terms of how things are explained in writing as opposed to a conversation where you can layer in some different views on it is, priority 2 is move away from selective hedging to systematic hedging. I really like that title that selective hedging is, we think of that as arbitrary. I'm going to decide when I make hedges or not, and it might be based upon my view of the future market. As corporate treasurers, our view on risk is to bring risk in line with our risk appetite and certainly our risk tolerance. Like, what are we willing to bear? And that says we're not making a call or a decision. When we say here's our tolerance level or our appetite, what we're willing to take on. We don't want things to fall outside of that. So we look at, how much exposure do we have? What are volatility levels? So we're making sure that our exposure stays within those boundaries. And so that is something that shouldn't be arbitrary, that we know what the market's going to be. We make those decisions to keep it in line. We're willing to bear all the risks under that. That's part of the cost of being in business. But then we also don't have the cost of hedging, hedging our FX risk. So those are a couple of factors. I know there's, as we talk about what goes on, unsystematic, value-destroying, selective hedging. Those are great words. I think those could be unpacked as well. Value-destroying selective hedging usually means I'm making a call, and which means I'm taking a position on the market, which becomes more speculative than I'm trying to, rein in my exposures and keep them in line with what's going on. I'm making a call. I'm making a decision, and that's not the role of the treasurer. That's not the role for most corporations. If you're a hedging firm, okay, you're taking a position on the market, and that's your business. But for corporations, most organizations, the goal is to bring those risks in line with the capacity, not only with the capacity, but the appetite, and oftentimes your tolerance, which might even be a little bit narrower. That's very systematic, and that's measured. It's more programmatic. I think that's really, really important. Hedges cost money. Over time, if you didn't have the issue of the volatility that exists, you could go ahead and say, I'm not going to hedge. I'm going to bear the up and down, and I will do better than paying and having this overhead for the hedge. But volatility is pretty significant, and that can impact short-term earnings. It can create a real cash flow or something very significant for the organization. Therefore, hedging matters, right? Mm-hmm. It's just like, why do you have life insurance? It's smarter to just put the money away. Yeah, sure. But what if you die earlier? You create an issue for your family, your loved ones. You're like, okay, that's something I don't want to tolerate, so I will buy life insurance or whatever the property casualty, whatever the insurance is. We do that on a normal basis. That too should be how we think about foreign exchange risk. That was the first one. There were some other ones, there were a few other ones that I thought were worth talking about in a longer form than we have today. The other one I liked is the centralized FX management, FX risk management. Number 5 is too often we see organizations where there's different groups, different finance groups, even perhaps different treasury centers that don't roll these up. They optimize their own FX exposure, their foreign exchange exposure within their region. And that sub-optimizes the entire process, as opposed to looking at all of the currency pairs that every single entity has in it. Because the fact that you can reduce the size of your FX transactions or your hedges, the fact that you can perhaps eliminate some of those, all results in saving money and covering your risks more effectively. So that's a significant item. You want to have that information, and you want to make sure that your team can look at risk comprehensively and on a net basis and do as few trades as is optimal.
Craig, those are some great points. Let's shift our conversation from Forex management to the third topic, which is about JP Morgan Chase's AI-driven cash flow tool that has helped some of its corporate clients cut manual work by 90%, as was reported earlier this month by Bloomberg. Tony Wimmer, head of data and analytics at JP Morgan's wholesale payments unit, said in the interview to Bloomberg that since the AI tool was introduced about a year ago, approximately 2,500 JP Morgan corporate customers are currently using the product for free. The cash flow management tool, referred to as an intuitive AI interface on JP Morgan's Analytics and Insight Solution page, allows corporate treasurers to analyze their cash flows, helping them sort, categorize, create, and forecast in seconds. The world's major banks, including Bank of America, are also accelerating adoption of similar AI tools. Craig, from a corporate treasury perspective, is the availability and adoption of such AI-enabled tools exciting news?
This is extremely interesting, exciting, and relevant. We think of the topic of forecasting. This is an area that corporate treasurers, treasury managers, directors all identify as it's a top priority. It's either number one or number two each year. We spend the most amount of time on it. We would spend more time on it if we could. We plan to invest in it. And senior leadership and management and the board even is very concerned about these items. So this is a core area of focus. We've seen the actual use of AI now through some bank providers, but also through some technology providers to leverage the power of artificial intelligence, pattern detection to help with this. And I think this is very, very significant news for those reasons. I think it's also showing commitments by some of the largest trillion-dollar banks. You mentioned a few of them. They're not just saying, here's your cash, here's how you can move it, but here's how we can provide tools that make it far more easy to see what goes on. Not everybody has a dedicated treasury system or a fully integrated ERP across the entire organization, but everything runs through a banking platform. And so this is excellent for banks, and in this case, JP Morgan, bringing this to bear. And you mentioned the 90%, saving 90% of what? It was manual labor. Pulling that stuff together, gathering the information, detecting patterns, testing your hypotheses, all of those require a significant amount of time. Much of it tends to be manually driven. And so this then frees up the time to do analysis, make additional assumptions, run different models to see how that can be tightened down. But mostly it's not just freeing up time that they're going to reallocate. It's doing work that they haven't been doing. Most are not getting everything done on forecasting for what they'd like to do. They're not running as many models. They're not running as frequently as they'd like to do. This is a really, really big lever, and it matters. This is a good fit because it's addressing a key area, an underserved area, an underused area. I think this is really significant, and it's showing the value of AI. And this is one of the early ones, right? Pattern detection for fraud situations, forecasting, and now this is being rolled out in scale.
Well, I couldn't agree more with your astute insights, Craig. And I individually will be watching this space very, very carefully. Next up, let's delve into the fourth story, which is about corporates grappling with counterparty concentration risk. A year out from the spectacular failure of Silicon Valley Bank, turmoil in the banking sector still plagues corporations in the Americas and Europe, Middle East, and Africa regions, according to ICD's annual client survey. 4 in every 5 respondents said they are highly or moderately concerned with bank failures, while 74% are concerned with counterparty concentration risk. Craig, do you share the same concerns? And if you do, can you suggest a measure or two that can help treasurers mitigate counterparty concentration risk?
Yeah, I'm probably more concerned than what goes on in the market. I'm concerned for a couple of reasons. I mean, finance people, treasury, we are supposed to be adults in the room. The smart money, we're supposed to look and say, what are risks? I mean, we're risk managers, and we need to manage those risks appropriately and carefully. We know and have identified these as risks. They're not a surprise, and yet how many people are actually changing what they're doing, acting differently? The data, I think, from the ICD's annual client survey talked about 61% changed the way they manage counterparty risk. Frequency of monitoring, 21% of those updated investment policy restrictions, strategy, and did a couple other things. But look at the percentage of that. It's 61% changed. And that's just saying change. That doesn't say we're monitoring everybody, we're calibrating it, using market data, using NRSRO data, nationally recognized statistical rating agencies like Bloomberg, S&P, or Moody's S&P as an example of that. We've taken surveys, we find people are changing the way they're doing, but not formally and not in a thoroughgoing manner. It's significantly less than half of organizations track their counterparties' exposures and measure it, even on a monthly basis. I mean, think about that. So we've had another set of failures. We go back to 2008, 2009. significant turmoil in the markets, lots of failures. There was a movement there, and that was more significant than 2023 and what we've been hearing in 2024. That moved the needle marginally, okay? And even now, it's like, okay, we're doing some more things. We're touching at it on the corners, just on the edges. So I'm very concerned because the mature adults aren't paying attention to this. And I think it's a significant issue. Yeah, I think the concern over counterparties is something that can be addressed and can be addressed relatively easily compared to many of the things that Treasury has to do. And the majority aren't doing close to enough. It's going to be indefensible. How are you going to defend it? The defense of nobody knew that this bank would go down. Okay, we know that you might not know which bank is going to have a problem or what counterparty is going to have a problem, but those things can happen. And you did what? You didn't do enough. You didn't do what was sufficient. I think that's a significant issue.
Well, pay heed to the wise words of Craig. Finally, Craig, what is your choice for the biggest or most important story of this past week and why?
Yeah, I think you probably heard in my voice which ones I was probably more engaged on. I think that the AI-driven Cashflow tool takes the prize because of how impactful that is to almost every single company. And not every company is experiencing it yet, but they will. This will flow and impact everyone. Some of the other elements about currency risk and the Fed kept rates flat. They still expect 3 interest rate declines, probably 75 basis points is the general consensus of where it'll be at the end of the year. That's interesting, but it's not super dramatic. It's pushed out to the end of the year. But these are tools that will change multiple thousands of companies, financial performance, their ability to see better and perform better. I think that's number one in my mind by a significant margin.
And do you see any negatives or any concerns with using these tools?
That's a really good question. I always remember it was some type of motorhome, and it was some guy was driving on some really straight highway out west in the U.S. And it had cruise control. And I don't know if this is a made up story or not, but the car was going and he had it on cruise control. I don't know if it had the lane navigation stuff or what, but I think he thought it was completely controlled. He went back in the back and was making a sandwich, and he eventually crashed because there was no guidance on what was going on. And so these tools help detect patterns, but there still needs to be some wisdom aligned with that. What's changing in the future? Historical patterns aren't going to tell you what's going on in the future, how your business mix may be changing. So you definitely have to feed more information into it and wisdom and guidance. You also have to be able to check to see, does this make sense? A good forecaster understands the flows, the change, certainly over time, and they have to be willing to adapt to new information, as it changes slightly over time. The fact that people can perhaps see those and have some of their assumptions changed is good, but it can't be a complete reliance on it for, hey, these numbers are fine, they came up, because bad information can get produced. You see it on language generation, like it makes up things that don't exist. That may not be the case on making up things that don't exist on data and flows, but it doesn't have the whole picture. It only can be trained on the data it sees. It only can know with the projections based upon your inputs. And so your inputs and how you guide and control that is, there still needs to be someone operating. You don't need 10 people flying the plane anymore. You've got 2, however that's changed over time.
Well, finally, Craig, is there anything else that you would like to share with us? Any other insights before we draw this episode to a close?
The only thing I would leave you with, Push, is that for those that are listening on Counterparty Risk, make sure that it's formal, that it's organized, that you take enough steps so that you, at least on a monthly basis, all of your moderate to large counterparties, you're calibrating what those exposures are, and you're making sure that those risks are in line with your tolerance for what you could potentially bear. When things go bad, they go bad very quickly. And don't be caught hoping that some central bank or FDIC is going to bail out your institution on the weekend. That's not a really good strategy.
Thank you, Craig. I want to express my heartfelt gratitude to you for sharing your thought-provoking viewpoints. Your perspectives have added considerable value to today's discussion. We would also like to express our deep gratitude to our CTM File audience for joining us on this edition of the Open Treasury Podcast. Please subscribe and look in the show notes for the article links. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.